I'm Keith McCullough. Now, welcome back. Third leg, and certainly not the weakest leg. We don't have any weak legs. The only weakness here is probably me, trying to get to the finish line here. But again, Neil Howe. So for those of you who don't know Neil, you're going to get to know him here and now. An open question for me has always been, how do you incorporate the longest term? Okay. Because I talk in the framework, if you can throw up slide 20, guys, of trades, trends, and tails. So that's, in many cases, it can be considered shorter term relative to Neil's work. Neil, of course, is a demographer, long cycle, both politically. He can give you anything that you want to know in terms of the four turnings of the political environment and otherwise. But this trade trend tail model lives in this 3 weeks or less. What are we talking about today? Immediate term type stuff, 3 months or more, which is intermediate term trends. That's why we call them trends. They matter big time to getting your portfolios right. Asset allocations, which we just spent some time on with Dave Root. And then long-term tail risk. I never go beyond 3 years because I'm really bad at that. But Neil's really good at that. So that's how we I guess we kind of met. Because you're the guy who coined Millennials. You've written how many books? 9 on demography?
Yeah, at least.
And there's going to be another one coming, I think.
Yeah.
I think I have a little inside info on that.
Yeah. We got a couple of them actually.
Yeah, and your work will never be done. You're always contextualizing. What I love about you is that you're one of the few, if the only, that can take what is happening in this intermediate term cycle and put it in the context of the long-term secular. Like we talked about this with Daniel Lacaille briefly, but he came back to usually where I'm at, which is in that 3 month to the next 9 months to the next maybe 2 years. But you're really good at zooming in and saying, hey, look, I know that you think that now, but that would have to reverse a long downward sloping trend. So maybe start with like one of those, which a lot of people, Daniel Lacaille and I take for almost a given, slower for longer in terms of real GDP growth in the U.S. and slower for longer on inflation or a mean reverting nature to inflation. So you get cyclical inflation, then it goes away, then bonds go down, bond yields go down, bonds go up, et cetera. Is that something that can be threatened? The inflation component, maybe take that first. By hyperinflation, we get questions on that all the time, which has been a dead wrong thing for people to go with anytime we see inflation at its cycle peak like we just did last year.
Well, that's been dead wrong for about 10 years, right?
Yeah.
Ever since the GFC, and when the Fed took extraordinary measures, as well as Obama. Remember, and I remember it was about 2009, 2010. Everyone was saying, "My God, this is going to be high." That was a terrible call when you think about it. And I never thought it was a great call either. That's why the economy was very slow. We were deleveraging. It was a terrible recession. But I think it's really interesting how we work together because my short just overlaps a little bit with your long, and so
right. Your shortest term is my longest term.
Yeah, kind of exactly. And recently I think one of my shortest term calls in terms of contextualizing where we are in the kind of what I call late cycle dynamics, right? Sort of this kind of late cycle we're in, really late recovery. Is that we are going through a period of epic, I should say, historical slowing down in the growth rate of the working age population. Mm-hmm. I would say this is the single biggest thing that people don't understand about this cycle as opposed to any other cycle. We peaked in year-over-year growth in the working age population probably around 1998, in the late 90s. And that was about about 1.2 or 1.3% year over year. Still small by longer term historical standards, but that was the mini peak of that era. We are going down to the year, I think, 2021. I have a chart on that somewhere, but to near absolute zero. I think it's about 0.1. Okay.
Of the working age population growth rate.
Growth rate.
Yep.
So what's happening is really interesting. Now, why is that happening, right? Well, it's happening because the millennials are started out with some big numbers at the beginning, but now we're getting late wave millennials coming in who are smaller in number. But the biggest reason is boomers are retiring.
Boomers are retiring.
Boomers are all going over age 65, and increasingly now they're going over age 70. And yeah, senior labor force participation is rising, but nonetheless, that's a huge exodus there. So what's happening is, weirdly, with this recovery, whereas the year-over-year employment growth is still stuck in the, well, it used to be just a bit over 2, but it's still between 1.5% and 2% growth, right, year over year. And it's like Wile E. Coyote, because the underlying growth rate in the working age population, the floor is sinking out underneath.
Yeah.
So it's this huge gap now, right? And I show that if you look at
expansion running out of work.
So you look at that, right? You see that those blue bars are declining over time. That is the underlying ability to expand employment growth, right?
Yep.
That's the working age population. And yet, either measured by CES or CPS, our year over years, although obviously coming down from where they were in 2014, right? That was kind of the peak. They're coming down a little bit, but they still have that huge gap.
Yeah.
Okay. Now, it's true that occasionally, historically, you look back in the mid 1990s, when Greenspan, the maestro, he was able to design and engineer a soft landing. Think about that. He did. He reduced interest rates, and he got us to that soft landing. You see, take a look at that slide again, because that's a good one. Do you see those rates come down and kind of touch the tops of those blue bars?
Yeah.
You see that? That was
like
our
that.
soft landing. But typically what happens is we go off a cliff. Okay. Typically what happens is we have employment growth which is much faster than the working age population, and then we hit a wall and we go way down, right? And that's our pattern. All I'm saying is there's been a lot of years of white space in that chart.
Yep.
And if you look at where we are in age gender groups, every single age gender group except for millennial males is above where they were in 2007. That's my point. And when I say we're running out of workers, means you have to assume that we are going to go above the peak of previous expansions in terms of our employment to population growth by age gender group.
And this is like one of the core ways to think about calculating the capacity or the GDP of an economy. I mean, if there's no capacity to grow, I mean, you can't,
And
that plus productivity
this
gets
is why
you close to the answer.
when you talk about, quad 1, 2, 3, and 4, I just say, well, what I'm looking at says we're either in quad 3 or 4. This is a choice of which one of those we're in.
Well, quad 3 and 4, if you use a 3-year to 10-year window, that's the easiest call to make. That is called slower for longer. Quad 3 and 4 are the same thing happens if you look at slide 6, guys. They're the only two quadrants where you have growth slowing. Okay, it's like do you have growth slowing with inflation or without inflation, and is that inflation cyclical or not? It's also interesting if you guys go to slide 102. While Neil's talking, I usually have to rifle through slides in my own deck to make sure that I'm am I thinking about what he just said properly? And he said 1998. Look at this. You're so good, man. This is perfect. This is vintage Howe. All right, I'll draw on this. But this is the rate of, because Neil is just showing the 20 to 64-year-olds. You call that the working population, right? What I anchor on, admittedly, is the 35 to 54-year-olds, right? So these are the people that make the most money, therefore have the most capacity to consume and spend money in an economy. So it's the same way of coming to the same answer. But lo and behold, what did Neil say? The rate of change, and again, we're both looking at rate of change. The rate of change peaked right around, look at that. And then all it's done is gone down. I mean, it's not. Right. At some point, this is the millennial kicker. That's right? On the other side of it.
By the time you get to 2030, you get that, right? But you've got, but throughout the 2020, if you're looking at all working age population, the 1920s is really low throughout.
Yeah.
It's just a low decade. Early in the 2030s and 2040s, you get the echo boom. So the millennials were the original echo boom of the boomers, right? Yeah. And this is going to be the echo. So these are going to be the millennials' kids. So you're going to have a little bit of that. There was actually a famous Swedish economist who termed this effect. So that when you get a very large bump in the population, you get an echo bump and an echo bump. You see this around the world in certain countries like Iran, where you have this enormous shifts in fertility. It gives rise to these
bumps.
Echoes that kind of go through time.
Mm-hmm. Well, that's an interesting thing too, and the world is not all similar in that regard. And I know you have thoughts on this, guys. If you go to slide 100, and we look at the growth rates on a 5-year CAGR, which now I'm at least above your low end of your duration, Neil, right? So on a 5-year CAGR, again, looking at the growth rate of 35 to 54-year-old population, you couldn't be more divergent in the world, right? You just mentioned Iran, but you have Saudi Arabia right here, and you have Italy down here. And Japan is off the face of the earth, as everybody knows, demographically. But the world is finally at this point where you could make some serious asset allocation problem, like some major problems in your portfolio by assuming that the world is just one demographic curve in this regard. Where in the world do you think, have you thought, is this an appropriate way to consider opportunities? I should color code that so everybody. Is this an appropriate way to consider long versus this starting to think about slower for longer being more readily apparent?
Well, I did a big piece on that yesterday. So
you did?
Yeah,
there you go.
We went
I didn't
through.
Actually know that.
That was our big video where we actually went through the long-term kind of relationship between economic growth, demography, and real interest rates. We kind of looked at that, and I actually own. If you want, I don't know whether Josephine has that, but if you could actually put up, I have my own quad. Do you want to show that?
Yeah,
Josephine, do you have that? Yeah, when
Josephine, like to us, she's kind of like, there you go.
No, that's the late-term spread cycle. That's different. There's a quad bubble chart way to the end of the presentation.
We'll get to it. Yeah. Josephine's like Siri.
Yeah.
We can ask her. Is this it?
There we go.
Oh,
okay.
How good is she?
Okay, this is incredible. Okay, so this is my own quad. So what this is basically for the next until the year 2045 from this year, I believe it's 2018. So go forward. This is the population growth rate is on the y-axis over the next future several decades, and then on the x-axis is current GDP per capita on a log scale.
Oh wow. Okay.
So it shows you that we are actually not badly situated among other countries, meaning that we are relatively affluent for the kind of population growth we're going to experience. So take a look at that. It's interesting to look at that. Take a look at, obviously, China and Russia are negative. I mean, China is a big economy, but it's sitting there negative.
That's horrible.
It's still not up to middle income, ceiling. I mean, China remains a poor. We forget that, right? It has this very urbanized and industrial coast, but it remains a poor country. But you look at some of these others now. A lot of your basket cases demographically are down there. You see Germany and Italy and Portugal and Greece, and right, they're kind of in your quad. I guess that's your quad 3.
That's because they're on the y-axis. They have negative population growth.
Exactly, negative population, even though they're relatively affluent. And then you look at your opposite in your northwest corner are all of the poor, more relatively growing states. Now, if you go into sub-Saharan Africa, just what I call the economically irrelevant part of the world. I mean, just realistically, they're not relevant. But then they'll be off the scale there. Mm-hmm. Very high growth, very poor. They're beneath, I think the end of that chart is like $1,500 per person.
Yeah, on GDP, per capita consumption, exactly. Even lower than that.
But interestingly, the United States is sitting there. We are by far the largest country in that, the kind of that quad 2. And there are a few others out there.
And
there's Australia. Israel is the great outlier.
But the reason why you're in quad 2 in terms of the population growth rate is because it's not absolutely negative and obviously negative like the European countries are. So the UK had an immigration generation, so they're going to have a little bit of a kick, whereas Germany did not.
There's a bigger rule here. All of the kind of Anglo-Saxon countries generally have had a higher birth rate than the continental European. Yeah, generally. We had a bigger baby boom after World War II, and we've generally had a higher birth rate. Plus, countries like Australia and the United States have much higher than average immigration. I mean, certainly that's part of the reason why Australia is there with us in Quad 2. So that's what's kind of that's what's kind of driving that. But one interesting point here that I often make in your chart, which I actually borrowed one version of this in the
slide
presentation
100,
I gave, is that I make the point that I often tell people, and that is because people often, when I talk about global aging, they think global aging. Well, that's because people are living longer. I mean, no, general, and it is true. Most of the world, particularly the developed world, people are living longer. Actually, most of the world, people are living longer. But that's not the reason why we're experiencing global aging. Global aging is overwhelmingly driven, at least 3/4 driven by falling fertility. That's what's causing aging. There are fewer young people replacing that. And it's taking a population pyramid that used to look like this, making it horizontal, and then obviously with a lot of countries now around the world, South Korea, Japan, and so on, it's inverting, sort of. It's inverted. That's what's causing it. It's the decline. And one of the reasons why this is interesting is that whenever you chart the dependency ratio, is basically, the elderly to the rest of the population, but you're doing the old age dependency ratio, with any measure of the growth rate in younger people, you will always get that curve.
Right.
Meaning the reason for aging is that the growth in the younger age brackets is slowing.
Right. Which is why it's actually why I use slide 103. Like in Europe, there aren't enough young people to offset. If you're just looking at that basket of 35 to 54-year-olds, in Europe, all you do, as opposed to the millennial big bump, in Europe, it's just falling off the face of the earth and staying there.
Yeah,
because they don't have a young generation they don't have a millennial generation that was born.
Well, they have a millennial generation,
size.
but in size they're not, and this is a generation that's getting used to, kind of a no growth future, and it's radicalizing this generation. By the way, it's millennials in Italy that overwhelmingly voted for 5-star in the Lega Nord. I mean, this is being pushed by millennials.
How about in France as well, the yellow jacket?
Well, France the same way, but again, it's the populism of both the right and the left. Like Mélenchon with his, France insoumise, we do not submit, But anyway, it's radical left or radical right. And I often tell people that I think the biggest thing that's happening around the world in terms of this kind of authoritarian populism is that if you get rid of your ideological blinkers and always think about right versus left, and I know it's very hard for a lot of us to do that. But
in Europe, you just go left.
But you can go either way. And I often make the point that in Europe, if you want to know where moderate, middle-of-the-road leaders are least likely to succeed, it's in societies where you have a very dominant both extreme right and extreme left. And France is one of those societies, which was why we predicted from the beginning that Emmanuel Macron's approval ratings wasn't going to look any better than, what's his name, that socialist who came before him, where it was just, down, it's pathetic. I mean, Macron right now, dreams about having Trump's approval rating. Yeah. So that's how bad things are. But the reason is because they want, particularly the younger voters, want something radical. And it really doesn't matter whether it's left or right. And as you see about Italy, you can elect them both and have them both take power at the same time. So.
Well, it's amazing because people. I'm a big believer, just because market history is, that if you show me an economic slowdown, certainly one that's developing into a recession, I'll show you political problems. So what Macron's rating looks like the rate of change of the French economy. It is not drifting, it is careening towards recession, just like Italy's did. So that's the biggest question I have with charts like this, which is this is the most sure thing, and I am very much unsure about many things in markets. But I am certain that with time and space, that is the demographic setup of the core spending population in Europe. So why are we constantly asking ourselves if Europe can't go into a protracted recession?
Well, here's an interesting point, and that is it's what I call aging recessions. Kind of a new phrase, an aging recession. You know what an aging recession is? An aging recession is when your working age population, which is going to be true of much of Southern Europe over the next 15 years, is actually shrinking faster than your economy is growing, even in a good year. Think about that.
So that's terrible.
A lot of the Southern Europe is going to be shrinking at over 1% per year.
Yeah, that's what this is.
Over
on the y-axis,
per year.
this is.
Okay. Well, I didn't even see that, but yes. Yeah. So it's going to be over 1%.
For sure.
Well, productivity today in much of the developed world is often not above 1% positive per year. okay? Which means an aging recession is a recession with full employment, meaning that even in a good year with no cyclical problems, you are actually having negative GDP growth quarter after quarter after quarter. This is why Europe, unlike the United States, had about 3 mini recessions after the GFC, right? They have all these mini recessions. Well, they're going to have more mini recessions. It's why Japan has had, been in and out of recession several times. The reason is not so much that they're mismanaging their macroeconomy from a cyclical perspective, from a beneath potential capacity perspective. They're right at capacity. That's not their problem.
Yeah.
But
from an employment perspective,
yeah,
they're right at capacity.
Yeah,
so this is part of what you gave a presentation on. I mean, when people look at negative interest rates, particularly long-term interest rates, negative Japanese government bond yields, negative Swiss 10-year yields, it's almost like the academic who hasn't studied any of these long-term growth factors is say that's just wrong. That's just due to central banking. That's just due to central planning. Yes, that has a lot to do with it, but it's a function of the demographic reality. They look like interest rates truly look like the slope of this line, and like this have gone to a negative number.
This is why talk about the natural interest rate, which was an invention of the late 19th century by Knut Wicksell, the Stockholm School. No, he actually quoted natural interest rate. And it's been revived now. The monetarist, the Taylor rule, is really based on a non-accelerating inflation idea of sort of the long-term, real rate of interest. And it's often in academic models. This is called R star, the R star, and all the Fed presidents. Interesting little tidbit. John Williams, who's now, used to be at San Francisco Fed, he's now what? I think he's vice chair of the FOMC.
New York Fed. New York Fed head, vice chair of the Fed.
He says he dreams about R star.
He dreams?
He dreams about R star. So he dreams about that long-term, isn't that just like a Fed president? I dream about that long-term equilibrium. So anyway, that's what he does. He dreams about it. So some people count sheep, he dreams about R star. So, but here's the point, is that if you look at neoclassical theory, R star is positively influenced by population growth and productivity growth, basically multiplied times each other. So it's basically real GDP growth, and it's negatively influenced on the kind of the denominator side by the savings rate. So more savings, less real GDP growth, you're going to get a lower R star. Okay, so that's basically, and what's happening around the world? Well, savings is rising. We have a lot of people preparing for old age, particularly boomers in a lot of these countries, right? And population growth, working age population is declining, and productivity has definitely been declining post-GFC, right? So this is why people are looking at this less, I think today, less from the viewpoint of financial repression, which is how we were looking at a few years ago. Right. Oh, it's the Fed, it's the Bank of Japan, is all the. No, it's probably kind of a long-term, a new long-term equilibrium. Right. Now, I think in the very long term, I don't expect that to continue. I do think we are going to have, political and social changes as kind of create a new policy regime. But if everything just drifts on the way it's going, yeah, you can expect lower real rates for the long term.
There's no other reason why utilities would be making all-time highs every other week.
I've noticed
and that's actually the epic bull case for gold. If we get real yields to fall precipitously from here and be pervasively weak, that is the epicenter of the bull case for gold. And what's interesting on gold is that you almost had like this mid-cycle, well, not mid, almost. When U.S. growth had a cyclical acceleration, what real interest rates do? They went into quad two. In quad two, gold gets smoked because gold competes with real interest rates rising. Gold only likes it when real rates are falling. I think it's slide 84 in the current macro deck, guys, if you want to find that. Just the empirical evidence of that. And I wonder if people, like, gold is such an under...
So I've noticed that strong correlation. I assume that's just because there's no holding cost, right, as the real rate goes down.
Yeah, it's an absolute return. Right. If you guys, I think I'm on the wrong slide there, guys. But if you flip ahead a couple, maybe just flash through a couple slides. There's a demographic slide. Keep going. There you go. Actually, one back. Go one back. Slide 87. So that's showing you, real yields versus the U.S. Real yields and the dollar effectively versus gold. So, and it makes sense. I mean, if gold hit its all-time high, of course, in 2011 when Bernanke was devaluing the dollar to a 40-year low and interest rates were collapsing. So gold clearly likes, real yields falling because it's an absolute return. It's just competing. If you give me negative yields, I'll do better. If you give me rising yields, competitively, I look less good. And that's, I think that when interest rates broke out and people were fascinated with Bitcoin, all the anti-government people, which I certainly wouldn't take myself out of that realm, they just went away from gold and they went to Bitcoin. So you have a lot so that are not long gold anymore.
That didn't work out well, did it?
No, it didn't. And Neil, by the way, is the guy who called the top in Bitcoin. So anyway, you want to talk about gold or Bitcoin? Probably Bitcoin.
I'll talk about anything
Bitcoin
you want.
today, Neil. This is
I pride myself into just riding with your.
Let's do Bitcoin
punches
because you're the guy who called Bitcoin, and now that I've tempted people's palates per se, this is news as of this morning. It's in my notebook, so it must be true. Bitcoin CBOE abandons futures contract trading.
Oh my God, I didn't know that. That just came out.
Remember, this was the big catalyst,
Yeah,
Neil.
of course.
Now it's going to broaden the financialization of Bitcoin, and asset allocations worldwide are now going to be sufficient for institutions because, you see, they're going to trade properly with futures and options contracts just like any other asset class. No, I'm not the CEO of a Bitcoin company, but that's how it went.
Yeah, well, I thought Bitcoin was a bad idea from the beginning. And I thought...
Bubble, you called it. Epic bubble, I think.
Yeah, particularly when people started to talk about it as the new money. I mean, if it's just sort of a speculation because it's this weird new technology and we haven't decided what to do with it yet, who knows, right? I mean, my attitude is let them bid it. But when they begin to justify it as the new money, I said, no, that's not going to work. So I did a presentation, as I recall, it was in December. It was right near the peak.
It was right at the peak.
And
because we have the hate mail to prove that.
And I went through. So it was a presentation that went through various theories of money. But I will tell you that the one internal contradiction about Bitcoin that I think lies at the heart of the problem of Bitcoin as currency is in the whole phrase cryptocurrency. And that's the problem. The crypto part of currency. And I basically said, I came to the conclusion as I looked at this thing, I said, not only would governments around the world, starting with the most authoritarian ones, and by the way, they were the first to crack down on it, but all governments, I said, not only would they not tolerate a cryptocurrency, they could not survive a cryptocurrency. I mean, my God, none of us would pay our taxes. I mean, literally, none of us would do anything that government has to do. Every government since the beginning of time has regulated and looked at, and it's usually the ones that issue currency. So I said, this isn't going to happen. And it didn't happen.
Well, the first power users of Bitcoin were people using it for illicit activity.
They still are.
And
it's in terms of transaction costs, that's the only people for whom that makes sense.
Yeah, I mean, it's an amazing thing because particularly in our world, in institutional investing, all of a sudden we had all these Bitcoin experts that were not experts at getting any kind of return in macro for like a decade. And all of a sudden now they're going to tell me how, which they had a very hard time getting anything right in currency, fixed income, or equities. Now they're going to tell me precisely why I don't know anything about all those calls, and this is the new currency. Of course, that ended up being the peak, but because that's when a lot of hedge fund managers started using Bitcoin as a core asset allocation, core long book. Maybe it was just to try to give them that last gasp. But there was a point, too, where the number one thing you could say back to me, because I was defending you, by the way, because you're the one who made the call.
Taking all the punishment.
Like I'm the one, I got the Hedgeye brand on my forehead, so it's like I'd always have to cede the point, but it's a great technology. And yeah. I read I think 5 or 6 books on the topic. I tried to educate myself the best I could. There was a lot of narrative-based storytelling there, and there wasn't a tremendous amount of just hard-coded rate of change fact that's more to my liking. And the history that was recounted by a lot of Bitcoin authors really was one that was based in the realm of unawareness, I guess. No real comprehension of an economic history, as you point out, the history of money, what would make for a currency to begin with. So now today, I'd still cede the point. It's a great technology. But what do I do with that? Is there ever a point where this could actually, and it's interesting now, because the dollar may stop going up. And that's when the Bitcoin does, particularly well, or did last time. Is there a chance that this thing could go from 4,000 to 8,000, in your opinion, long term, not change?
Well, it's the question of what productive use is that technology going to be put, right? And it is an interesting technology. There's no question about it. The question is, what's that worth to anybody, really? I've heard a lot of proposals. I haven't seen anyone really, yet do a lot with it. I actually think what's fascinating is, and I think this is what people are going to regret, is I think that increasingly central banks will be issuing their own, virtual transaction currency, which may or may not work with, this kind of technology. It may just be sort of an open ledger. It's obviously going to be transparent to everyone, but it's going to allow people, if they want a very easy, costless, digital currency, I think governments will soon be providing it. This is now the reason why governments want this kind of thing is to drive cash out of circulation, which has been their goal for a long time. Because the whole idea is that, well, two things. First of all, and I can't remember the guy who wrote, you remember This Time It's Different, the guy about debt, I'm talking about.
Reinhardt and Rogoff.
Yeah, Rogoff. So Rogoff also wrote another book, a long screed, a rant against cash. If we got rid of cash, the whole world would be a safer and more moral place, right? So the reason why governments don't like cash is, as you already pointed out, cash is where most of the criminal activity of the world goes on. I believe most of the actual currency is held by foreign countries, probably by mobsters and terrorist groups. God knows who holds all that cash. But if we could run the cash out of existence, we'd get rid of all this way of all the underworld activity. And also, the next time there's a bad recession, we could engineer negative interest rates. We could really have not only just ZERP, but NERP, because everyone would be forced to use digital currency, so we could actually penalize you for keeping money in your account, right? Getting rid of cash would be an incredible nirvana for the Fed. So the great irony is that the real ideological edge of the whole Bitcoin movement was guys like James Dale Davidson and Rees Mogg, and they were the sovereign individual. These are boomers, and all the experts that followed them. These are all libertarians. They believe radically in the idea of no government, and we're just, with no need for trust. I mean, talk about an ideal society for most Gen Xers. No trust necessary. Yeah. So anyway, we're going to do a world without trust. And that was really, it was actually, I think, an ideological edge to a lot of people's interest in Bitcoin. It was sort of the kind of world, socially, politically, that they really wanted. And unfortunately, ideology, as you know, and you've often spoken about that in your programs, ideology always warps your market-driven judgment, right?
Big time. You don't want to start with ideology. If you're marketing an ideology and you're good at it, you might make a lot of money in a short period of time, but that doesn't mean that your views on it are going to be non-cyclical and or crashing. And that's what sadly has happened to a lot of purveyors or salespeople of the Bitcoin, and all the what I'd affectionately call the shit coins that came in and around it, where a lot of people got sucked into it, and they're basically frauds. Enough about that. Anyway, we have a lot of questions, including your Bitcoin questions, gold questions, MMT. We may want to start with it. Let's actually start with that, Neil. And if you have questions for Neil, he can pretty much forget more than most human beings on the way to the bathroom. He's not going to be able to go to the bathroom in the next 15 minutes. All right, so we're going to keep you here. Some are embracing MMT, Neil.
Yes.
Is this another big tailwind for gold? So first, explain what MMT is.
Well, MMT, modern monetary theory, which is being, there's a professor out of Stony Brook who's kind of a big promoter of that and has been to Congress and talking to, particularly on the Democratic side of the aisle, to Democrats. But it's out there. And basically the idea of MMT is I should just say, just broadly and speaking about money, and again, this is sort of very deep sort of intellectual history, there are kind of two theories about the origin of money. One is the barter theory. You know, we started out bartering, just trading goods for goods, and then then gold and other things and so on. So it's basically that's the kind of the libertarian theory. It's always
Or
been
the Canadian
favored
guy from like the Hudson's Bay Company, like
yeah,
me,
you got fur, and it's a fur. How about a piece of paper? But then there's a whole nother theory which also has a long kind of intellectual pedigree, which is more the purview of sociologists, and that is government. The money was really a creation of governments. And there's a lot to say for that, because in fact, that's how money was originally introduced. Now, it's the government people, right? That whole theory, that whole intellectual pedigree kind of feeds into modern monetary theory, and that is, it's government that creates money. I mean, forget this whole idea that it all comes from gold and there's some intrinsic value. No, it's a system of social credit. And society makes a collective decision to create it. They can do it as they wish. All currency has always been fiat currency. I mean, this whole idea that only recently we've had fiat currency. So anyway, that's the idea behind monetary theory. You don't have to worry about how much you issue, because you can issue any amount you want so long as the economy is running at full employment, and so long as you keep inflation to down to a reasonable degree. Now, I will say that the argument for monetary theory post GFC is a lot better than it was, right? Mm-hmm. Because no matter how low we get interest rates, we had trouble getting to full employment. And inflation never seemed to show up on our radar screen. So I think this is the reason why modern monetary theory is so big. The reason it's going to be practically important is not now when unemployment is down at 3% and all that. It's going to be a big issue come the next recession, mm-hmm. right? That's when it's going to hit, right? And we haven't even talked about that. When is the next recession? Is that going to be perfectly timed for the next election or not, mm-hmm. right? That's going to be fascinating.
There are many more Democrats believe in this MMT than certainly, like you said, libertarians. Or
but their chances of introducing that are going to be hugely improved at the right political juncture with the economy on the right condition.
Yeah.
Wait until the economy is flat on its back with our unemployment rate up at 10% and 11%, whatever it is. Suddenly the Fed is sitting there flatlining at ZERP, right? Not knowing what more of the... Come on.
Yeah.
Modern monetary theory will be back. Plus, huge fiscal spending. And the two kind of merge together, right? Mm-hmm. Modern monetary theory and huge fiscal deficits even greater than we have now, so long as you get the economy back working again. What's the matter? We did it in World War II. We did it during the New Deal, mm-hmm. the Green New Deal. Come on, you got that? You got the New Deal and the Green New Deal?
Actually, we're getting some questions on that, by the way.
Okay.
There's actually a question on climate change, if it figures into your outlook, does it?
On climate change, I'm more of Matt Ridley, the guy, the British intellectual who wrote a number of great books on genetics and evolution and so on, but he coined a term, because he actually covered climate change for many, many years, but he coined the term lukewarming. He said he's a lukewarmer, which means that he thinks that rising carbon dioxide levels are responsible for a little bit of warming, but not a lot, and not nearly the kind of alarmist picture that people think. I'm kind of more of a lukewarmer. One interesting thing...
Lukewarmer sounds like Luke Skywalker. It's like an appeal to people because it sounds like it makes some sense. Lukewarmer.
Yeah, I was a little bit more of a Han.
Because you can't just be like you can't be like a total like tree hugger, or you got to. It sounds like a little bit more neutral. No?
Yeah, it kind of sounds disgusting to me, actually. But anyway.
All right. Great thinking on the economic direction long term, Neil. Central bank policy will likely continue to counter the demographic gravity and fall. Failure will likely manifest in market and monetary crises, so slow with chaotic big bumps ahead? ? Sounds like more of a comment, but a lot of people believe. I got into this with Lacaille. A lot of people believe that no worries, more cowbell, markets can never go down again.
No, I don't believe that. And actually, I think
were you around October to December? You were around, right? You were on this side of the earth, on the right side of the grass.
Yeah.
The markets went down a lot.
I know.
Memories are so short. It's almost like people watch the market day to day and they completely forget what happens. You could have, if you're long the Russell 2000, which is a pretty broad index of U.S. stocks, it went down 27% from August the 30th to December the 24th. What could go wrong?
Yeah, that's called a bear market. Yeah.
Yeah.
Exactly.
I mean, it's a crash.
So, but I think what they're referring to is the idea: could the economy go down?
Yeah.
And not only do I think it will, I actually, and this is where I part with a lot of people, I think it's a good thing. I actually do. I think that is when we correct institutions and we rebuild institutions. I think the idea that you would have an economy just constantly dribble along, is actually not good for us.
Well, especially
we
when
need
you talk
periods
about
of reconstruction, and not only that, but the whole point about market crashes depends which side you're on. If you're young and you're beginning to invest, you get to buy into the American dream at a discount. There are always two sides to a transaction. And I do believe, when I see the media following Wall Street all the time, and every time markets go down and real estate prices, whenever the prices go down, it's like a terrible tragedy. Yeah, for all the older people that own everything, but how about the next generations coming along, right? It's their opportunity. There are always two sides to a transaction. And for life to go on, we have to think about what's coming on after us.
Well, what you have seen is the opposite. Like, by virtue of not having a recession, this is the longest U.S. economic expansion in U.S. history. Republicans and Democrats, when it comes to monetary policy, have gravitated to the same thing. There's no difference. There's no difference between Donald Trump wanting more cowbell and Barack Obama wanting more cowbell. There's no difference between the Federal Reserve members, how they go about their day job. It's all one and the same thing.
Totally, but when the economy goes down again, and when we're back at that, that zero bound, then all this other stuff comes back onto the table. And I don't believe, by the way, that people talk about inflation. The governments can very easily engineer inflation if there were enough. I believe Japan was very near that point a couple of years ago, and the way they would have done it was simply to say, any worker or anyone with a payroll, you put your stuff in a bank and we're going to index it up by 1% a month or something like that. I mean, think about that. But no, in other words, you can engineer it if you have the incentive to do so.
Have a jubilee.
What are the advantages of that? Well, suddenly now your monetary policy has teeth. Once you get inflation going again, then holding that interest rate low, right, actually gives traction to your monetary policy. And we are going to see that if this next time puts us in that same situation. We're going to see a lot of the stuff that was only discussed before.
Yeah, and the inflation, to be clear, comes from the deflation, because the deflation is what causes the inflation. So, I mean, you come from a very asymmetric point. There's big opportunity politically in that, and you save the world, according to yourself. Let's see here. There's a lot of political questions. I don't want to go there.
No, come on.
What would be, or this is an interesting one, given you've coined the term millennials. What would be your biggest long-term bet as a millennial investor, given stagnation and slowing growth, if it comes to fruition?
As a millennial, so I assume they're just meaning.
If you're a millennial and you're looking, like, what's the best way to play your outlook?
Jeez.
The problem is there's not a real good answer.
People, how I would do it. I mean, other than all the standard answers about diversifying your assets and being geographically diversified, obviously at a time of crisis, you certainly want to be geographically diversified. I mean, I often get asked which areas of the you're the demographer, which areas of the world I should be invested in from that point of view, and you can see that. I mean, if you just look at any of my 20 charts on this subject, you can look at areas which are reasonably decent in terms of security, legal structure, corruption, and all that, and yet have high population growth. So if you're really looking for that wave, you're looking at the Malaysias and Indonesias, the Philippines, and so on. There is again, looking at quadrants, there is an area there where you can find economies for the long run that are probably going to, they still have a lot of catch up to do in terms of productivity. They're still going to have a productivity, dividend over the. So if you're looking long term, but be diversified because you never know how any one of those countries is going to go. But there are areas of the world where you certainly, particularly if you're a millennial, you probably have a target date fund, out there at, I don't know.
That's tough though. Those
2045 or
those
2050.
are old wall products. Like those are
well,
not.
you
like,
can't do it within that product.
Yeah.
So I'm saying if you can take some money out of that product, you'd want to diversify into those areas.
One way to think is like Josephine, throw up Neil's 4-quadrant map with the countries quickly if you can. What I think you're saying too, if I put it within the context of my process, is if we go to a slowdown, like one that's beyond stagnating to slowdown in the U.S., and then you have political change and you have MMT, the dollar is going to get castrated in that environment. And those countries that are in Quad 1 that you just showed are going to have, in dollars, don't forget that EM does very well when the U.S. government is burning its currency at the stake. So that is it's the rebalancing of global power. It's the rebalancing of incentives. It's a rebalancing of growth expectations to where you actually have the population growth going. Okay, so that's maybe another way to think about it.
Yeah, I agree with that, and it really depends a little bit on the nature of the crisis. I mean, obviously at the worst of the crisis, the dollar was strong because that was sort of the safe haven currency. But as things begin to sort out, the dollar may still be strong relative to, you're absolutely right with regard to the EMs. But we have, if we follow our sector, we, not only do I do this kind of long-term general stuff, we actually have particular industries we like. And I'll just mention 2 of them here because we've written about them.
Yeah.
Very particular industries which we are very bullish on from a demographic standpoint. One is pet care. There are a lot of interesting ways you can get it. Everyone's owning pets. And boomers and Xers have completely reimagined how we treat our animals, right? I mean, everything about them is the food and, it's organic. It's the amount of money we spend on pets today.
My father treats his 2 dogs better than I was ever treated.
They now have dogs now have parents and grandparents and they all have.
I'm joking, Dad.
Yeah, no, but we got but there's a huge change there, and particular sorts of. Although I'm not big social media generally, the kind of Google, Facebook duopoly, I'm not very positive on. I think that online dating is an incredible growth opportunity, and we had a piece recently on that because virtually everyone is waiting a lot longer to get married. Older people are getting divorced. And that's an entire area where there's been very little market penetration in.
You're along the screening process. I mean, that's pretty much it. The other one is cannabis. We've done an extensive amount of work there. You could see that the shifting patterns.
We have a whole sector now that does that. So,
but it's not shocking to see Shane Laidlaw's hockey sticking charts on cannabis consumption relative to alcohol consumption.
Yeah, totally.
And it is, he calls it pay per high or whatever he calls it, hit per high, because it's it costs less. Here's another question. This is definitely this could take you a whole day to answer this. Do you need capitalism and favorable demographics for GDP growth?
Well, obviously not.
Especially if you make up the GDP growth number, you can have it all the time. I mean, it's China.
You need some form of capitalism just to have any kind of efficiency in your economy. Right. So that's kind of a loaded question. I think the more interesting question is, do you need democracy? And I think that's becoming a bigger issue. I've written about that. Are millennials giving up on democracy? I think that's actually an interesting global question now. We know from a lot of surveys that millennials are less interested in democracy than older generations. And you look at, not only is it true in the UK and in the United States, but it's true around the world now. If you look at particularly East Asian countries, with these new charismatic leaders, Narendra Modi in India appealing to the Hindu mainstream, or you look at, Burma, they're the Buddhist mainstream, and, Uncle Xi is appealing in China to the great Han, all of these leaders, Shinzo Abe appealing to traditional, right? And then you go to this madman who's in charge of the Philippines now, Rodrigo Duterte, dirty Duterte as they call it. But my point is, is that you have these charismatic authoritarian leaders who are appealing to the mainstream of their country. They don't give a damn about who's on the fringes, right?
Putin.
Who is voting most for them? Younger voters. And that is fascinating to me, because earlier in the post-war era, the authoritarian leaders mainly were voted for mainly by the older voters. Younger people didn't want them. And that's changing around. And people often ask me this question: when do we know when the world is going from post-war to pre-war? You know, when are we going from a post-war mood to a well, it's kind of hard to tell until you have the next big crisis, right? But one key is that in a post-war era, it's the generation that just created the new era. They just went through the crisis, so they really identify with the institutions they build. And generally, younger people tend to want more freedom. They want less order. They want less rules. They want less conformity and all that. But eventually, as time goes by, right, those younger leaders are in power, and you generally have a pretty laissez-faire, libertarian world. And it's younger people who want more order, more certainty, more rule. You see what I'm going with this? That is a sign you're in a pre-war or pre-crisis.
Does that line up with the fourth turning? Pre-war?
Absolutely.
Yeah.
That's well, I don't say pre-war because that kind of predisposes what kind of crisis, but I say pre-crisis.
Pre-crisis.
Yeah.
For those of you that haven't read The Fourth Turning, I'm biased because I think that's your favorite book. Or I think that's my favorite book. Yeah. I think that would probably be a consensus, though. Is it not your people's favorite book that you read?
It's either that or the original one we did, Generations. Which was so that was kind of the first big book.
I guess we've had this question, and maybe a good one to wrap up on here, because people are constantly asking, where do you think the Trump administration fits within your framework of what is the fourth turning?
Trump, and I thought that the two most interesting, fascinating, and path-breaking developments in 2016 were Bernie Sanders and Donald Trump, because they were cutting edge on both the left and the right of this whole new kind of populism and authoritarianism, right? Authoritarianism on the left, every bit as much a possibility as authoritarianism on the right. And Bernie Sanders is a guy who believes in top-down government, just government making big decisions, creating winners and losers. And you always have to admire the guy. I mean, when was the last time we had leaders just say, this is how it's going to be, single payer, and millennials actually gravitate toward that. Yeah. The paradox of choice. Why have so many choices? I have something small, one choice, but it works really well, right? At least, and you find this now becoming a very dominant view on the left. So I think just like Jeremy Corbyn now, sort of the elder sort of great champion in the UK of the left, of the millennial left, and you have Bernie Sanders here. But I think that Donald Trump is the kind of the exponent or the leader, the first one who really galvanizes new populism. But if I had to bet, I would say that when this final populism finally takes shape in America, it's going to be on the left, not on the right. So this is why the 2020 election looms really large, and why when you look at futures markets, and remember again, I come back to this: the economy is now at 3-point-something% unemployment, and already you have futures markets predicting, right, that Democrats are going to come in and sweep in 2020. Wait until the economy is a little more negative.
If you take that outlook, and maybe last question on this, if you take that outlook, and again, I'm not trying to be political, I'm not a Republican or a Democrat, I'm Canadian, I say that all the time because it's of course true. But if you look at, if you take that, let's say the economy's slowing, we have quad 3 for 3 quarters in a row, that's my outlook, and if that's the path and what you just said is still the truth, what kind of a candidate and what generation could or should they be from within your lens would come out of the Democratic Party as the front runner?
Well, this is the big moment for Generation X, right? You got a lot of candidates in kind
Gen
of
X.
Gen Xers. You have Kamala Harris and Beto O'Rourke and what's his name from New Jersey?
Yeah, they're all my age, those guys.
Yeah. So
he's pro-cannabis too, New Jersey guy.
Yeah. But interestingly enough, you have a millennial candidate running. You know, this guy, Pete Buttigieg, out of South Bend, Indiana. He's 37 years old. And just to show you, and I actually had a piece on that recently, I think it came out yesterday, but it was an amazing statistic. I'll just leave people with this one amazing statistic, and that is, as proof of how absolutely disinterested Generation X has been in politics. You know, they're way behind the age curve at actually taking Congress, you know, taking the House, taking the Senate, taking US governors. At their current age, you know, boomers had already, you know, were into their third president and already had pluralities in both the House and the Senate. Gen Xers have been so slow. You know, Gen Xers in both parties tend toward the libertarian edge of their party, right? But as proof positive of how disinterested Gen Xers are in politics, we looked back and we looked at all of the contenders for the primaries in every presidential election since 1986. And for the past almost 30 years, the youngest contender in either party was a boomer, all the way up through 2012. There were no Gen Xer candidates actually contending for the presidency. Obviously, in 2016, you had a lot of them. The two younger ones were Marco Rubio and that guy from Louisiana, you know, the governor from Louisiana, Bobby Jindal. They were born in 1975. And interestingly, in 2020, we have a millennial contender. So only 1 year, only one presidential election was a Gen Xer, the youngest contender.
That's crazy.
And it's already been moving on to millennials. And this is what anyone who's read The Fourth Turning or my books knows. Bill and I used to always make the point that millennials are destined to make an early and strong entrance into politics as a generation, and basically filling the vacuum that Gen Xers have left behind, and even to some extent.
So they could circumvent Gen X presidential candidates altogether.
And you know, most Gen Xers always knew it was kind of in the cards. You know, they'd be bystanders.
1975.
Yeah,
I have a genuine. I do not hate, but I genuinely don't like any politician. Like, I don't like their parties. I don't like either party.
There you go.
And the ones that ran, to your point, Gen X, Rubio, like those are like wet Kleenex type. You know, like that's not a leader. That's not like, you know, you don't memorize your lines, and you know. Like, so I think that you're right. I mean, if you take somebody like me, I'm just like disgusted by politics and politicians. So maybe there is somebody there to inspire somebody, because I'd love to change my mind.
We do talk in our ratings about dominant and recessive generations. So between the GI generation, which fought in World War II, you know, the so-called greatest generation, right, that was in the White House for a long time, from John Kennedy, you know, born in this century, all the way up through, you know, George Bush Sr. And then we had a boomer. That completely bypassed the silent generation.
Yeah.
Anyone who remembers the Great Depression and World War II as children, but were, you know, not old enough to serve, that entire generation, nearly 20 years, was completely bypassed for the White House. And look what's coming up. You see, we do this. We have dominant generations, we have recessive generations in politics.
Well, I don't know if that's a good or a bad way to end today's discussion, but for us Gen Xers, we're just going to go back into our apolitical holes, and we're going to keep you data dependent as we tried to keep you across, by the way, durations today. Don't forget, we're trying to talk about a multi-duration framework, so whether it's short-term, intermediate term, or Neil Howe's super long-term, there's so many different things for us human beings to attempt to contextualize, and at the end of the day, we don't know what the real answers are going to be, but we can probability weight how we go along the way in terms of positioning ourselves and being in better spots than would have been if we were ignorant of a lot of these datas and economic facts.